Hello and welcome back to Global Value. In today's video, we are going to be performing a fundamental stock analysis of Moody's Corporation, ticker symbol MCO. Moody's Corporation is one of Wall Street's three large credit rating agencies. Moody's has a storied history on Wall Street. In fact, when Warren Buffett was running his initial Buffett partnerships, he spent his time searching through Moody's manuals, going A through Z, line by line, looking over every single stock in each manual to try to find investment ideas. Moody's has been a staple of Wall Street for a long time. Together with Standard & Poor's and Fitch, they're one of the three large credit rating agencies, and it's almost guaranteed that you need one of these ratings to be able to issue public debt in the United States. It's no wonder then that Berkshire Hathaway owns more than 13% of the company, and in addition to that, other value investors such as Chuck Ockery through Ockery Capital Management and Guy Spear through Aquamarine Capital also have significant positions of their portfolios in Moody's Corporation. So at the time of recording, Moody's Corporation is trading for $284.40 per share. Year to date, their stock price is down 27%. Over the past year, their stock price is down 25.5%. Over 5 years, they're up 16.5%, however. Over 10 years, they're up 21.5%. And going back 17.5 years prior to the global financial crisis, their stock price has compounded at a rate of 11.5% each year. Keep in mind that this return is also not including dividends. Moody's currently pays out a dividend yield of a little under 1%. So that's a dividend that's smaller than the overall market, but that does add to this return over time. So currently Moody's is trading about $33 over their 52-week low, which is down quite a bit from their 52-week high, down more than $120. Moody's is a large business. They have a $52 billion market cap. So for some more background about the business, Moody's, along with S&P Ratings, is a leading provider of credit ratings on fixed income securities. Moody's rating segment, known as Moody's Investors Service, or MIS, corporations, structured finance, financial institutions, and public finance ratings. MIS represents a majority of the firm's revenues and profits. Moody's other segment is Moody's Analytics and consists of research, data, and analytics, or RD&A, and enterprise risk solutions, or ERS. RD&A's products include credit research, quantitative credit scores, economic research, business intelligence, know your customer tools, commercial real estate data, and analytical tools, as well as training services. ERS includes risk management software solutions to financial institutions. Moody's Corporation was formerly known as Dun & Bradstreet Company and changed its name to Moody's Corporation in September of 2000. Moody's Corporation was founded in 1900 and is headquartered in New York, New York. So for our fundamental analysis today, we are going to be using the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Moody's Corporation based off of their business fundamentals. So this analysis is still a work in progress, and it's an opportunity to learn in public. It's going to continue to improve and get better over time. So with that background about Moody's and this disclaimer, let's get right into it. Starting off with metric number 1, we want their average 5-year return on capital to be above 14%. The first is that the average publicly listed company earns about a 7% return on capital. So asking for this 14% threshold is going to give us a margin of safety based on the overall quality of the company, in the fact that the company is going to be at least twice as good as average. The second is that over the long run, over the course of decades, a stock is going to return approximately what its underlying business returns, and these business returns are going to be captured here by return on capital. Over this time frame, Moody's is earning significantly above average returns on capital. However, it's worth noting that these have been declining over these 5 years. They started at about 32% returns on capital in 2017, and they are now down to 25%. Averaged out, Moody's is earning about a 28% return on capital in a given year. So this is 4 times better than average and twice the metric we were looking for. This is going to be a check to start off here on our first metric. Looking at this declining return on capital, though, is something you'd want to take a look at. There could be a number of different factors for this, such as different levels of competition and some of the overall macro environment that would potentially be affecting Moody's here. We're not going to speculate or get into it here. This is just something to learn more about when you're doing your own research into the business. Metric number 2 is going to be an all or nothing metric, taking a high-level look at the cash coming into the business. So we want their revenues, earnings, and free cash flows to all be growing over the past 5 years. If all three of these numbers are up, this metric is going to be a check. If even one of them is down, this will be an X. In the case of Moody's, they've increased all three of these over the past 5 years. Their revenues are up more than 50%, their net incomes have doubled, and their free cash flows have nearly tripled over this time frame. These are great signs to see here. The business is growing across all three of these metrics, and this is our second check in a row. Moody's is starting off strong here. Next up, for metric number 3, we're looking for earnings per share growth over the last 5 years. Moody's has more than doubled their earnings per share over this time frame. This builds off of metric number 2, but it's also taking into account their shares outstanding. So in metric 2, we saw that their earnings had nearly doubled. Here in metric number 3, their earnings per share have more than doubled. So what we can tell by that is that over this time frame, Moody's has been buying back shares and decreasing their shares outstanding. This is important because when you're purchasing a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. Over time, when a business repurchases shares and buys back stock, they're increasing your ownership percentage in that business, which, as reflected here, ultimately increases the percentage of the business's profits that you're going to be entitled to as an individual shareholder. It's as if a company is making an acquisition of itself and it's laying out money to reinvest back into itself. So this is another great sign to see here. Another check on metric number 3. Metric number 4, we're looking for free cash flow per share growth over the last 5 years. Very similar to metric number 3 here. Over the long run, both of these metrics should about average out. Earnings per share and free cash flows per share should be about the same. So over this 5-year period, it's not surprising that we'd see some years where earnings are a bit higher and other years where cash flows are a bit higher. It just depends on what's going to be flowing through their earnings statement in a given year. Here we can see that their cash flows per share have nearly tripled from $3.47 in 2017 up to $10.01 in 2021. So this is another check here on metric number 4. We are 4 for 4 to start off with Moody's. Metric number 5, we want their net debt, which is long and short-term liabilities minus cash and short-term cash equivalents, to be below the amount of free cash flow that Moody's has produced in the past 5 years. So this is going to help us evaluate the overall leverage of the business. Here we're comparing the net debt as of the end of 2021 to their past 5 years of free cash flows. It's important to compare free cash flows here because free cash flows are the lifeblood of any business. A business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable rate, is ultimately what that business is going to be worth. So a business can use free cash flows to pay dividends, buy back shares, reinvest back into the business, make acquisitions, or pay down debt. So in the case of Moody's, they had nearly $6.1 billion of net debt as of the end of last year. And over this time frame, if we add up all of these columns here in white, they produced over $7.5 billion of free cash flow. So this is another check here on metric number 5. Relative to the debt that they're employing in their business, Moody's is producing a lot of free cash flow, and they've got room to spare here. And we are perfect through 5 metrics so far. Finally, the big metric of them all, metric number 6, we want their average 5-year free cash flow yield relative to their total enterprise value to be greater than 5%. Total enterprise value is going to give us a more realistic economic picture of Moody's than their market cap will. It'll be as if the business were a private business. Total enterprise value includes their market cap plus their net debt position. Then the reason that we're using 5% is that it'll give us a slight risk premium to the risk-free rate. And if Moody's has an average free cash flow yield that's greater than this, it has the possibility of giving us even better risk-adjusted returns. So in the case of Moody's, they currently have a total enterprise value of $59 billion. And over the last 5 years, they've produced about $7.5 billion of free cash flow. So in an average year, they're producing about $1.5 billion of free cash flow. So when we take that $1.5 billion of average free cash flow and divide it by their total enterprise value of $59 billion, that is going to give us an average 5-year free cash flow to total enterprise value yield of a little over 2.5%. So about 2.56% here. This is going to be under the 10-year Treasury risk-free rate, and it's under that 5% metric we were looking for. So this is going to be our first and only X on Moody's Corporation. Here we're taking a quick look at Moody's dividend profile. They've increased their dividends per share in all 5 of these years, and they've almost increased their cash flows in all 5 of these years. It's down about 10% year over year from 2020 to 2021, but their cash flows have still tripled over this time frame. So relative to the dividends that they're paying out, Moody's is producing a ton of free cash flow, and it looks like Moody's is going to probably have plenty of breathing room to continue increasing this dividend for a long time into the future. So we've seen some great signs out of Moody's so far. If you're interested in the business for its abilities to return cash to shareholders, they've been both buying back shares and increasing their dividends, and it looks like they have plenty of cash flows to be able to support both of these activities. Then last but not least, here we are using a discounted cash flow model to come to a potential fair value for Moody's. We are taking their average 5-year free cash flow per share, which it comes out to exactly $8 here. Then we are incorporating a growth stage over the next 10 years with a growth rate of 14%. That's based off their historical abilities to grow free cash flows. Somewhat incredibly here, since 1998, Moody's has been able to grow their free cash flows at a rate of 14% annually. Even during the global financial crisis, which absolutely rocked Wall Street, Moody's was still producing positive free cash flows. That's an absolute testament to the strength and enduring nature of their business. Keep in mind that this 14% growth rate is a historical assumption. Over time, as a business grows, its growth rate is generally going to slow down. Then we add in a terminal stage over the next 10 years after that, so projecting 20 years out in the future, of only 4%. Then we're not adding in their tangible book value because this is skewed based off the business's buybacks over the years. If we're looking for a potential return of 10% on Moody's over the next 20 years, it looks like there's not going to be a margin of safety in the business currently. They have a stock price of more than $284, and if we wanted this 10% rate of return over the next 20 years, it looks like their business would have a fair value of about $183 per share. So we'd have to wait for the business to come down by about $100 here. At today's prices, using these historical growth assumptions, which have to be confirmed or disconfirmed by yourself through further research, these just provide a baseline projection into the future based off what Moody's has done in the past. However, this is not likely to be that accurate. It's just giving us this baseline. Then at today's valuations, it looks like you could reasonably expect about a 5% rate of return from Moody's. Keep in mind that this type of analysis and this discounted cash flow model are not financial advice. They are not a buy or sell recommendation of any security. Instead, they serve as a beginning and holistic starting point to determine whether it's worth your while to dig in and do more research here into Moody's. Before making any investment, it's important that you consult with the properly registered legal and financial professionals, and that you do your own homework to understand the ins and outs of a business as if you owned 100% of it. So then, in summary, Moody's checks the box on 5 out of our 6 metrics. They're only off on their average 5-year free cash flow to enterprise value yield, which is under the risk-free rate currently. However, we found out that Moody's utilizes appropriate amounts of leverage in their business. They've been buying back shares. They've grown earnings, revenues, and free cash flows over this time frame. Therefore, their per-share metrics are up over the past 5 years. And then Moody's earns about 4 times the return on capital that an average business earns. So that is just fantastic there. Then looking at their dividend, they've grown their dividend in each of the last 5 years, and they have plenty of cash flows to be able to support that dividend now and into the future. That's not a guarantee, but that looks pretty likely based off of their past performance. Finally, we used a discounted cash flow model to come to a potential fair value of Moody's. We found out that at today's prices, based off of historical assumptions of how the business has performed since 1998, it's reasonable to expect about a 5% rate of return on Moody's over the next 20 years. And then if you were wanting a 10% rate of return on Moody's, you'd have to wait for the business to come down to nearly $183 per share. So the last time the business traded around that was in March of 2019. So a business can come down. You just have to be patient here. These were based off of historical assumptions, and they are not financial advice. You need to validate these numbers for yourself and understand that this is just a way of creating a baseline into the future. It is likely not going to be an accurate way of valuing the company based on what the company is actually going to do. To determine that, you're going to have to dive in and do more research into the business if you're interested. Please, before making any sort of investment, if you have any questions at all, Consult with the properly registered financial and legal professionals. So with that, that's it for today's fundamental stock analysis of Moody's Corporation, ticker symbol MCO. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next. Thanks for learning about Moody's with me, and have a great day.